Hi, and welcome to CPAAccountantsIrvine.com. Let's talk about tax preparation. There are some specific steps that need to be taken when starting to think about filing taxes for yourself or your business. CPA Accountants Irvine addresses, if you're not knowledgeable about what you will require, a CPA or accountant can be instrumental in helping you prepare and file your taxes. However, you will need to understand the initial setup of filing paperwork and what type of business you are establishing. So, what is a corporation? Most businesses start out as a small company owned by one person or by a partnership. The most common type of business when there are multiple owners is a corporation. The law sees a corporation as a real live person, like an adult. A corporation is treated as a distinct and independent individual who has rights and responsibilities. A corporation's birth certificate is the legal form that is filed for the security of the state in which the corporation is created or incorporated. It must have a legal name, just like a person. A corporation is separate from its owners. It's responsible for its own debt. The bank can't come after the stockholders if a corporation goes bankrupt. A corporation issues ownership shares to persons who invest money in the business. These ownership shares are documented by stock certificates, which state the name of the owners and how many shares are owned. The corporation has to keep a register or a list of how many shares everyone owns. Owners of a corporation are called stockholders because they own shares of stock issued by the corporation. One share of stock is 1 unit ownership. How much one share is worth depends on the total number of shares that the business issues. The more shares a business issues, the smaller the percentage of total equity each share represents. Now, let's talk about partnership and limited liability companies. Some business owners choose to create partnerships or limited liability companies instead of a corporation. A partnership can also be called a firm and refers to an association of a group of individuals working together in a business or professional practice. While corporations have rigid rules about how they are structured, partnerships and limited liability companies allow the division of management authority, profit sharing, ownership rights among the owners to be very flexible. Partnerships fall into 2 categories. General partners are subject to unlimited liability. If a business can't pay its debt, its creditors can demand payment from the general partner's personal assets. General partners have the authority and responsibility to manage the business. They're in agreement to the president and other officers of a corporation. Limited partners escape the unlimited liability that the general partners have. They are not responsible as individuals for the liabilities of the partnership. These are junior partners, and they have ownership rights to the profits of the business, but they don't generally participate in the high-level management of the business. A partnership must have one or more general partner. A limited liability company, LLC, is becoming more prevalent among smaller businesses. An LLC is a corporation regarding limited liability and its partnership regarding the flexibility of dividing profit among the owners. Its advantage over other types of ownership is its flexibility in how profit and management authority are determined. This can have a downside. The owners must enter into a very detailed agreement about how the profits and management responsibilities are divided. It can get very complicated and generally requires the services of lawyers to draw up the agreement. A partnership or LLC agreement specifies how profits will be divided among the owners. While stockholders of a corporation receive a share of profit that's directly related to how many shares they own, a partnership or LLC does not have to divide profits according to how much each partner invested. Invested capital is only of the factors that are used in allocating and distributing profits. What is a sole proprietorship? A sole proprietorship is a business or an individual who has decided not to carry his business as a separate legal entity, such as a corporation, partnership, or limited liability company. This kind of business is not a separate entity. Anytime a person regularly provides services or fees, sells things at a flea market, or engages in a business activity whose primary purpose is to make a profit, that person is a sole proprietor. The IRS requires that you file a separate Schedule C profit or loss from a business with your annual individual income tax return. Schedule C summarizes your income and expenses from your sole proprietorship business. As the sole proprietor of a business, you have unlimited liability, meaning that if your business can't pay all its liabilities, the creditors to whom your business owes money can come after your personal assets. Many part-time entrepreneurs may not know this, but it's an enormous financial risk. If they are sued or can't pay their bills, they are personally liable for the business's liability. A sole proprietorship has no other owners to prepare financial statements for, but the proprietor should still prepare those statements to know how his business is doing. Banks usually require financial statements from sole proprietors who apply for loans. A partnership needs to maintain a separate capital or ownership account for each partner. The total profit of the firm is allocated into these capital accounts, as spelled out in the partnership agreement. Although sole proprietors don't have separate invested capital from retaining earnings like corporations do, they still need to keep these two separate accounts for owner's equity, not only to track the business, but for the benefits of any future buyers of the business. For more information and to schedule a free consultation, please visit us at cpa-accountant-irvine.com.